Alrighty, well, welcome everyone. Thanks for those from our board member clients that were able to join us this evening, and we'll be able to let folks in that join after the start time. But quick introduction, I'm Eric Stazak, Executive Vice President with w360. We have Aileen and Steve from our Denver office also on the call with us this evening, and then my esteemed colleague in accounting, John Pertigao, who will be helping run through the presentation, focusing on financial literacy and making sure that board members have a good, simple understanding of the most routine financial reports that we utilize, operate with, and will give you the best guidance for understanding the financial position of your community, and things to look out for as you review your monthly financials as those are reconciled and distributed to board members. And then secondarily as well, a nice tie-in to the start of budget season. So a timely time to take a look at some of these if you are, equal opportunity for those that are super involved and really know the ins and outs of your financials, and for those that really don't and are looking for that little bit of just additional guidance, context, and support. So John's going to be able to take us through a number of things that really help, I think, just set you up for success for budget season as you get your drafts incoming from folks like Aileen, Kathy from our office, and others. I think this will help you understand the rhyme and reason to a lot of that philosophy, help you verify financial information that they've included in their budget proposals, and just help you through the rest of the season. Again, as a quick reminder, we will be recording tonight's session, so that is currently ongoing, and we will be taking notes. So by tomorrow, I will share transcripts from the notes and kind of actions from the meeting along with the recording. So if you do have board members that couldn't make it, colleagues at other communities that you want to share this with, this is open for everyone, not just Westward 360 customers. So feel free to share amongst your board colleagues or other community members that you know of in other communities. And then this will also be recorded and posted to the education section of our website as well. So you'll be able to easily access it there. But we'll go ahead and get started. So again, we are today focusing on financial literacy for board members, primarily understanding financials, budgets, reserves, and the associated reports with those. Quick factoid that I always think is just kind of interesting to revisit every year, just because this number climbs more and more. But just a quick for what it's worth. There are 370,000 rather community associations in the US, with 12,000 of those being in the state of Colorado. Really, that means that almost half of Colorado's population lives in a community association. So when I do mention about like sharing with community members or people with other associations, it's very likely that, 1 out of 2 people that you know is in an association themselves. So a lot of this stuff can be really impactful, whether folks are in a fairly low hassle subdivision, or if you're in a very complex condo association with many stacked units. So just a lot of it in place in terms of the HOA industry and where people are living these days. And that really follows trends through a number of other states throughout the US as well. Today's agenda, we're primarily focused on reading financial statements and the basic reports. The basic reports that are included in your financial packages, things like your balance sheet, your income statement, which often functions as a budget versus actuals, accounts receivable, prepaid, things of that nature. The subtle differences between different accounting bases. So things like cash reporting versus accrual reporting versus modified accrual. Those might be terms that you've heard at some level. Maybe you understand them, maybe you don't, but tonight's section should give you a little bit better clarity on that. And then finally, duty of care, loyalty, and fiduciary duty, just because all of these things culminate into you exercising and following through the responsibilities that you have as a board member to follow that duty of care and duty of loyalty that comprise your fiduciary responsibility as a board member for the community that you represent. John, can I turn it over to you to walk us through financial statements?
Absolutely. All right. So again, as Eric said, my name is John Pertigo. Just so you folks know, I am a CPA, MBA. I have been a CFO for the Los Angeles Times newspaper, the Houston Chronicle, and the Las Vegas Review-Journal. I've been working with HOAs for the last 8 years now, so I've had a little bit of experience in all this stuff. But anyway, financial statements, as it says here, produced basically for two reasons. Number one is to provide internal, external users, yourselves and other people that you might need, the homeowners and so on, with the basic economic info. I'm not going to read every single thing. I'm going to paraphrase some of it because I think we can get through it a little faster and see if there's anything better out there, to talk about. To enable, and also the second one is to enable the community association board and the manager to have a resource to be able to figure out what is going on financially. All right, so the first report we'll talk a little bit about is the balance sheet. As it says here, it's a summary of the financial position at a given period in time, and that's really important. It basically only is good for that moment, because of course cash is coming in, cash is going out, things are changing. But for that moment in time on 12/31, if you're an annual, a regular December fiscal, and so on, that one would be one of the points in time. What it basically tells you, what you own, what you owe, and how much is left over. And as you can see there, basically the basic formula is always assets equal liabilities plus retained earnings. Retained earnings is, as it says there, basically what is left. And when we see one of the examples of the actual balance sheet, I'll go into a little more. Okay. Here are some of the basic items that sit on your balance sheets, and almost all of you will see these one way or another. Operating cash, that is a fund, and I'll talk about funds a little bit later, but with one of the big things we strive for and use is different funds to do different things. Operating is a fund that basically, as it says, all your operating things are going on. So it has operating cash. They usually have reserve fund cash sitting on them, and you'll see they're in two separate columns because we keep those funds separate. Accounts receivable, basically, as it said, it's basically assessments that are due to you, haven't been paid yet at that point in time. Prepaid expenses, these are expenses that have been paid in advance for one reason or another. Usually a good example of this is insurance. All of us pay insurance. You have to sometimes pay 50 grand up front to get your policy, but that's good for the first 6 or 7 months. We'll put it in here and then expense it onto your balance sheet as it's incurred. And that's what's important, is one of the terms. And that's one of the subtle differences that Eric mentioned about cash versus accrual accounting. Your liabilities, accounts payable. We don't have a lot of that. What you'll have is a lot of accrued expenses. Don't jump yet. Prepaid homeowner assessments is a really important one because, again, anything received before a due date is technically a prepaid assessment. The association has not earned that yet. Any long-term debt, other liabilities, you'll see some examples of them, but that would be in your liabilities. The last part of that balance sheet is your equity. Again, retained earnings is basically what it says there. It's the fund built up from the prior years. It normally doesn't change during the year. The thing that changes is your net income. Your net income is basically feeds directly from the income statement, and it goes up and down, depending on what happens throughout the year. At the end of the year, that gets rolled into retained earnings for the next year, and you start with zero. So let's flip to the next one. Income statement.
And feel free to pause in between if you do want me to switch over to any of the individual reports.
I was thinking about that. Why not? Can you flip over and let's look at the balance sheet real quick? Because why not before they jump? So perfect. Here's an example of an existing balance sheet, and we redacted information, of course. But you can see what I was talking about, the operating, the reserve, and the total. As an association, this association has $109,000, but the reality is they only have $7,000 in operating for everyday expenses, and the rest is in their reserve fund, $101,000. Again, reserve funds, once they've moved in there, really are like a separate world. They're set up and they're not controlled, but the right way to say it, I think, is all of us, well, most of us, I don't know if all of you guys, but all the ones that I've worked with have a reserve study done every couple of years. That reserve study basically shows you what you as the association are going to need to do over the next 20 years. And it's going to say you need $5 million, let's say. But you don't need $5 million today. You need that over the next 20 years. So it tells you you need to build up your reserve fund to have X by each year. You know, it'll say you need $1 million by the end of year 3 because you have to replace all your roofs, let's say. So you would have to plan for that as a board and as the manager. They plan for that to say, I know I need to do these roofs. How am I going to get there? What do I have? And this is what you have. You have $100,000 in cash, basically. The next one below that is accounts receivable. 99% of the time, the only place you will have accounts receivable is in your operating side. There could be others if there are multiple funds. There are associations out there that'll have, I've seen as much as 9 different funds. And I'm going to be honest, it's just because they have like a townhome versus a villa versus a master, or not master, but you know what I'm saying? There could be different
Those
components.
more complex associations that have a
Yes.
lot of different movements in and out. And
Yeah, and that leads me to the next one, the assets below that, which is the due to, due from. Slide down a little bit more so they can see the mirror to that. There it is. So in this case, the operating fund owes the reserve fund $10,000, $9,900. So that's in the assets. So the reserve fund is due $10,000 for numerous reasons. Periodically, oh, we got to make an insurance payment. We don't have enough operating cash. There is a mechanism out there. We don't like to use it. We like to plan better than that, but there is a mechanism to borrow from the reserve fund, and it has to be repaid. Because it's basically almost, you treat them like they're 2 different companies, even though they are the same association. And sorry, that gets a little complicated, but it's just one of those accounting things to keep things clean so that later on, each one knows how much is available. The next thing.
And I was just going to add, just from like a managerial perspective, if you ever hear about like the term like commingling of funds, like the separating the cash balances and the funds into distinct operating and reserves, that's what helps avoid like the very taboo reality that some boards that don't have professional guidance or some kind of lousy management companies out there, when they commingle funds, that essentially means that they're intermixing your reserves and operating cash, and it's a jumbled mess. Like you're not getting a good handle on what truly is an operating expense, what truly is a reserves expense. Earmarked funds for projects are now mingled with general operating funds. So this is very much the reason that we want to show this just visual representation, is that it's very real and that these are in very distinct accounts, but we also want to show that distinction between operating and reserve. And hence, like this due to, due from, this trips board members up sometimes who are unfamiliar with seeing balance sheets, but the very reason is that so that we can actually track like and avoid that commingling. Otherwise, if you're not doing a good, reliable job of monitoring those funds, we don't know that there's $9,000 plus that's due to the reserves from the operating or vice versa. So it's very important that we're tracking these things so that you're not, just scratching your head and saying, wow, the reserves sure looks like it's a lot lower. Wish I knew why that was. These things on the balance sheet will help you get a better grasp and understanding of that. Sorry, John, wanted to add a little bit of color.
No, that's good. And then prepaid assessments, as we said, those are homeowner prepaid assessments. Now, the equity section down below here, all of you, I think, will see this kind of section right here. It has a retained earnings. It has an opening balance equity and a net income. The opening balance equity is when Westward took you into our system. What we do is seal up that old number. And we do that for a number of reasons. Technically, I'm not responsible for that number, but I am. I mean, you're always responsible, but we like to show it versus the one above it, which is retained earnings, which is what's been happening since you've been part of the Westward family and moving along. So in this case, you can see that this association probably over the last year or two has lost $64,000 in operating. So what they've been doing is overspending on the operating side, hence the reason they need to borrow money. And this year, right below the net income, shows you that they've again have spent $2,300 more than they've taken in. Now, there could be a timing issue. I don't know right off the top of my head. Where on the reserve side, you see the opposite, which is what should make sense. They've basically been building up cash, and this year they've taken in $2,900 more than they've spent, which happens. Now, a very important thing that many people get messed up with and is important. Operating funds is where you pay the majority of your taxes when you owe taxes. Okay. You all are a zero-sum game. Okay. You always try to hit zero when you budget. And then when your year goes, slide down to the next statement that's there, which is we're a little ahead, but this is the income statement of revenues and expenses. What's really important. So if you see on the far right, it says annual budget. The nice part about our reports is we're always going to show your annual budget, regardless if it's month 1 or month 11. Okay, so you'll always have a picture of saying, well, I'm about halfway through the year. I got about 40. I'm almost halfway. It feels okay or doesn't feel okay. You know, you can kind of see without having a lot of information. You quickly, from this one report, you can see. But now slide about halfway down till you get to the net income piece, because I just want to go over something with these folks. Keep going right there. So, okay. So what happens is at the end of the year, if you have a profit, okay, like sorry, I moved my mouse like I was going to be able to show it to him. The 4,300 in the monthly column, I haven't gone over this, is just 1 month. But let's say that was the year. Technically, most of your accountants who do taxes there are a number of different mechanisms to allow you to kind of not get away with that, but not pay tax on that. The only thing you're always going to have to pay taxes on is interest income. Okay. No matter where it is, be it in the reserve side, be in the operating side. That's the one thing that you can't get around. So associations that have a lot of money end up having a tax burden. Okay. And it's just part of what happens. If you have $1 million in the bank, you're going to pay some taxes. Okay. And you need to keep that as board members and as managers. You need to keep that in the back of your mind to say, well, I know they're going to earn, so they're going to have a little tax that they're going to owe. It's just one of the things. Can you flip to the other report? Not this, the slides.
Back to the presentation. Yeah.
Presentation. Thank you. So now I'll just go over this quickly and then we can jump back to that other one. So the income statement feeds the balance sheet. That's the one important thing. And you kind of, saw where the net income is what flows in. The pieces that are sitting, and the other thing about the income statement that's important is it's for a given period of time versus the other one was just a point in time, meaning it's good for today. This one shows you what's happened for a month, a quarter, a year, depending on what you're looking at. And these are the basic items that you kind of see on there. You see your income, operating income expenses, your total, your reserve, your budget variances, and slide down to the next slide. I can't remember. Other way. Good. So go back to the report now, please.
Mm-hmm.
Thanks. Okay. Yeah, there you go. Back up to the top of it there. So this is the income statement, really a basic report. It shows you what you're taking in. Now, we haven't talked about cash versus accrual. This is where it will change. The real numbers that will change on a cash versus accrual is really your income is one of the biggest ones, because what we do in the accrual world is we record all the income because it is technically earned by the association, whether or not it's collected. Okay, that's an important distinction. So right there, this association earned $8,200 and $1,700 of special assessment, so $10,000 in income for assessment type products. One of the nice things about our income statement, it is broken up into sections so that you can kind of see your assessments. You see different things like your supplementals. This one doesn't have it, but there's a miscellaneous section if you really have some miscellaneous stuff. But there you can see late fee income. This is a transfer from reserve. So remember, this was one of the ones that owes. When money comes between funds, we have to record it, and we record it mainly on here, but it also, again, flows through to the balance sheet. But this is where you actually see it. So they took in $1,300 and you have to record it somewhere so that way it doesn't get lost. We want to keep it in multiple places, and that's where that's. If you slide down this report a little bit, you just see, and just keep rolling. It's just the basic expenses. So keep going, keep going. I want to stop a little bit further down, right about here. There, this is good. The utilities, slide up so we can see the utilities. So one of the other big things in this report is it shows you, and you can't see the titles of the columns. If you were looking at it, you could, but basically you have your monthly expense, your monthly budget. That's the second
So this
column.
is, this is the just to clarify with folks,
Yeah.
this is the actual, this is the budgeted, this is the variance.
Yep. And then the same thing in the next set of columns is the annual, the year to date of the same expense line. So electricity, these folks, as you can see, have been off by about $15 there, but then they've been off a lot more for whatever reason probably earlier in the year in electricity, and they're almost double, more than double of their budget of electricity has been overspent for one reason or another. And I don't know, because I don't know this association specifically.
And from just I'll insert just from like a manager perspective, if you're a board member reading this report, two things that I would think of just to give you like real world examples of why this would stick out to me, and some questions that I should ask as a board member, or, things that your manager should be looking at too, are like twofold. One, if our actual for year to date is 1890 and we were budgeting, 781.50 through the first 5 months of the year, the very obvious thing could be that this was just very badly budgeted. That, realistically, the electricity spend is going to be far and away beyond what was actually budgeted for the year. You'll see that the annual spend the annual budget reflects that, 1875 was budgeted. We're at that spend already. So this could be an instance where, maybe the line item wasn't informed with like the best financial data. Second, it could be a poor reflection of when that association actually incurs like most of its electrical bills. So, in the Denver area, maybe during the winter months, you have a number of electric heaters that are on to avoid, things like burst pipes during inclement weather. And then you turn those off when weather warms back up. That could be an instance of maybe, we should have weighed, or the board should have weighed those expenses heavier in, the early parts of the year. And then those expenses kind of just, they trickle downward as those elements aren't utilized. So when you do see these big variances, those are some of the things. Maybe it's the way that like the budget, that line item was weighted throughout the year. Maybe it was just that the overall number was off base. Maybe there's just an error that was, transposed in the entering of the data into the system. So when you do see some of those variances, that does really help you kind of understand like whether that kind of makes sense for, where you are in the year, or if you've got, an overage or an underspend that might be kind of concerning and deserves some questions to be asked.
Yeah, perfect. That's actually a very good point. Budgeting, we in our system, by the way, can break up that budget. So that $1,800 could have been weighed in the first 4 or 5 months and not much or anything at all in the end. It depends. It's up to you guys. When you see the budgeting as you go through it, there's all those capabilities. First, you look at it in whole, of course, and then you kind of break it up. But one of the big things is right at the end, operating net total. We went through the 4,000, the 2,000. The big one is, see how the year-to-date budget, it is budgeted to be zero. So all the way at the right, it is budgeted to be zero, which that's what you as an association, all of you, are trying to do, right? You're not in there to make a profit. You're not in there to lose money. You're there to take in assessments and spend those assessments for the betterment of the community. And that's the whole thing we do. Slide down to the next portion of this because I wanted to just go through it, is the reserve section. So this is is going to be new for some of you because I've talked to some of the managers and I know we like to track reserve spending and income this way. The reason is it's very transparent to you. Now, this, of course, doesn't have a lot in there. Sorry, I could have tried to find a little better example, but what it does is it shows you how much income you're bringing in, and part of that income is that reserve transfer. Now, see that $824 and the $4,120 for actual for year date. Now, Eric, slide up to the operating section and you'll find the same, keep going a little more, just above you, right there. Here's the expense side of that. So again, like I said, things between the funds always get recorded. So there's a trail of things happening. So this is money that for the budget, this particular one said they're going to send $10,000 into their reserve fund this year. This is what they're doing, and they're doing this every month. And so they continue to do it. And down below, here's where it's recorded. It's coming into the fund and it's there. So you can see it. Down below, they haven't done their reserve study yet. And see, that's where whenever this budget was done, it should have been, hey, we're going to spend $3,800 on a reserve study. And that sounds like a lot, but I won't go there. But anyway, you do it, and it's usually done in a period of time. So we could have made that budget all in June. Let's say I'm going to make that up. Down below, transfer to operating. This is the money that you saw way up above that showed they were sending money from here back to there. And you see that $1,300. Again, we track everything so that you as the board and the managers can look at these reports and say, okay, I know what's going on. I feel comfortable with this, or I don't feel comfortable. Now, when those monies get paid back, there are actually other lines that get added in here that you wouldn't see because they're not budgeted and they're not here right now. But we track all of that back and forth so that you guys can feel comfortable and understand what's going on. Slide down. I can't remember. The next one is the cash disbursements. Oh no, AR aging. So let's go back to the slides, please, the presentation. So let's talk about, this was what we had started to talk about, and the cash versus accrual. 95%, and I think that's right, of all of Westward's associations use the accrual or modified accrual basis. Reason for that is many states actually by law require that you do modified accrual. It is the generally accepted accounting principle for companies, for almost everybody. Cash is allowed in some instances, and there are some small associations where we will allow cash to happen, but the better method is always the accrual method. The big difference, as you can see, cash is basically like your own checkbook. You take in some money, we show that. You took in $1,000 this month, and you spent $500 extra. Next month, it's the opposite. And we just keep tracking that for you, similar to what you would do on your own checkbook. With the modified accrual, the biggest one is the income being recorded as it's earned, but also the expenses are recorded as they're incurred. So what that means is at the end of any given month, the accountant will scan that income statement before they're finished, and they'll say, oh, look, I don't have an electric bill. What happened? They should go in, or the manager will catch it. Somebody will catch that we didn't get a bill. They will then accrue that bill. And what that basically means is they will do a journal entry at the end of the month to record that expense and put it on the balance sheet. What then happens is the next day, on the first of the next month, that entry reverses. And basically what happens is we put a credit where that debit was. And sorry to use those type of terms, but basically where that expense was, it disappears and the real expense comes in, but it zeroes out because we've already recorded it. But still, that's just a method, and it's basically a one-day entry so that way we can show you where you really are, because you really have spent that money. Whether you've paid for it or not doesn't matter. In reality, you've spent it.
And that's just to butt in again, like that is a big takeaway that John just mentioned. And the reason that like modified accrual and accrual based accounting, even though we get boards who sometimes are like, hey, cash is just easier for me to understand. I definitely get it, but accrual does really help tell the true story because as you can imagine, like just because you haven't gotten like your electric bill in your hands doesn't mean that you just have $100 extra in your checking account to spend. Like you don't want to be making your business judgment decisions as a board, just, basing it on what is in your checking account that day. You need to factor in those upcoming bills that just because they have not, the payment hasn't left your account, that your operating account will be impacted by it. So, knowing that you have an insurance installment due next quarter of $3,000 might change your buying decisions as a board member. Rather, you had not known that $3,000 expense was coming up, right? So modified accrual and more accrual-based reporting helps ensure that as, certain bills come in and expenses are actually realized, that we're not just waiting to report on that when it leaves the bank account, that it's actually recorded knowing that that's an upcoming liability. Ultimately, you're getting a much more accurate sense of what real money you will have on hand, what real debts are out there versus just operating a bit more blindly based on like John mentioned, like as if you were just balancing a checkbook. It's a bit of a different animal and doesn't really tell the entire story.
Now,
Sorry, back to you, John.
The last piece of this slide is the fund-based reporting, which I mentioned earlier. This kind of spells it out. Operating is for daily operations. I mean, it's the easiest way to think of it. Reserve is really major repairs, major replacements that you plan for, not the emergency ones. Now, and that's where we run into some challenges there. And there is a little flexibility there, truthfully. But if you have a storm that takes out a bunch of balconies, that's not necessarily reserve item. That's really an operating item because it happened. It's not something that you knew it was going to deteriorate and you were going to. Now, if it was deteriorating and it was on the schedule, that's a different story, and that's where I'm saying it's a little bit kind of thing, but it's really major repairs, major replacements, roofs, gates, walls, things like that, those kind of things, repainting, things like that, like little expenses normally will not show up in the reserve side of the world. So like if you spend $200 for a bunch of signs, that's not a reserve expense. That's an operating expense. Even though people will say, well, it's part of the project. And, and myself, I look at it and I say, well, is it really, did we talk about that in the reserve study? We did. Okay, let's put it there. No, we didn't. We got to put it in operating. And again, it's not a huge deal. The biggest thing is you as the board members do not want to have to ever go back to your people, your homeowners and say, well, we need more money. We've got to do this. You want to have planned for the roof, or you want to plan for the repaving of the parking lot kind of thing, versus coming to them and saying, well, the prior board didn't do it. We got to repave, it's all full of holes. You guys are losing tires every other day. It's going to cost $10,000. Everybody's got to pay $500, that kind of thing. Special assessments, those happen often, it happens, whatever has to happen happens. So, all right, let's go to the next slide, please. Oh, perfect. These are the basic rest of the reports that will be in your package of financial reports. And most of you have probably already seen them. So let's jump back to the reports and we'll just kind of go through them there instead of here.
Yeah, give me 1 second.
Oh, no worries. And we're going to talk about accounts receivable. So that's one of the big ones. This tells you who owes you money and how long. So slide so they can see the whole report. Again, a point in time, and it kind of gives you, hey, this one. The nice thing is the way our reports are set up, and depending on your collection, I don't know what the right word for it would be, system, because we have one that we use, the PSI system, and it sends out friendly reminder. It's got steps built in to just automatically do these things. And so here. The first one, as you can see, has owed some money for a while, over 90 days, and so on. But this just gives you a snapshot of who owes you money and what's going on. It helps for boards definitely to look at this, because sometimes it's just the fact that Joe hasn't gotten a bill and he or she can't or doesn't get on the internet much, and they might need a little extra. Hey, by the way, you didn't pay the last 2 months, and they'd be like, what? No, yes, oh gosh, my account, something. It's one of those friendly things that, as board members, if you know your constituent people, you do it. If you don't. I've had some where know everybody and they walk around and talk to them, and they keep this at a minimum, because of course this is money that you're missing in your account at this point.
And it's helpful too, just to kind of show the level of detail. So like, obviously we have just the summary information that just kind of gives you that like 10,000 foot view of, okay, we have a total accounts receivable or delinquency in the community of about $4,200. Here's what makes up that total balance. What I like about the individual, just list of what each individual owner's balance consists of, is that it helps you just discern as a board member what is, collectible, what is what's needing to go to collections. Maybe the collections policy for your community is that balance is over 60 days prompt, getting referred over to your collections attorney. Maybe your community has an over 90-day policy. So having it organized this way helps you kind of more quickly see which balances are really in collection status versus, what might just be more late fee and courtesy notice status. The other part we find helpful is that because it's itemized between assessments, late fee, whatever the actual GL code is for that balance, it gives you a sense of, the nature of that delinquency. Maybe you see a concerning number like 2,071, but let's say in this example, that wasn't assessments. Maybe there was a bill back for, a plumbing leak into another into the common areas, and the association had to bill back some expenses. That's important to distinguish, because that delinquency, maybe that $2,000 balance isn't actually as concerning. Maybe they do pay their assessments reliably and on time. Maybe they don't have a bunch of late fees racked up. Maybe they just got billed a large, pass-through expense onto their ledger. So having this additional context for you as a board member also gives you a better sense of, should I be or should I not be too concerned about this particular delinquency? Also, what's helpful is that this gives you the status on each of these. So this person with this larger balance is at the friendly reminder stage. If they were at the collection stage already, you would see that this might say like with attorney. So it gives you some nice, again, that glance over reporting that gives you a lot of good information regarding the nature and the context around your delinquencies at your community as well.
The next report is the prepaid homeowners. So this, similar to the report above of accounts receivable, this is the people who've prepaid you for one reason or another. And basically it'll have their account number, their property. It doesn't give you a lot because it's basically a credit on their account and their names, of course. But it does tell you that that first person's paid $2,700. So somebody who pays like the whole year in advance. I've run into that quite often, where somebody will say, okay, I owe $100 a month here. Here's $1,200, and they prepay it, and they just don't think about it for the rest of the year. And this is the kind of thing you'll have in here for one reason or another.
Also a good report to reference if like you notice on like your balance sheet or your income statement that you are seeing that you've got like a pretty swollen checking account. Maybe there's more income that's been, than you expected. Referencing this report might give you some answers. So if you're like, oh, wait, we have, an extra $5,300 in our operating account that we weren't expecting. Is that just free cash to play with? Maybe not. So I would verify against your prepaids and just see, oh, we do have a number of people that maybe submitted, they like paying with one big lump sum check at the beginning of the year and let that, chip away at their credit balance over the course of the year. Maybe they accidentally sent 2 checks in because they forgot, and whatever the case is. But this will show you, as John mentioned, any of those prepays, which again might inform your kind of understanding of some of the other reports.
One other thing, slide back up to that for 1 second. One thing that not many people catch is this also shows you things, and by the way, the accounts receivable keeps this also, previous owners. So like in this case, this association has 2 previous owners on here, one for 500 and the other one for 256, that for whatever reason, it could be that they sold their property and paid. And then, of course, when the settlement happened, there was money left over. Now, normally what will happen is you as the board at some point will look at this and say, hey, can we cut Joe, who I know left, a $500 check? And this is one of the ways you would, the accounting does a number of steps before they do that. They go back to the ledgers, they go back to the old ledger, the new, they make sure of all the stuff. But this gives you a hint that there are a couple of old credits on here for whatever reason. Again, this is, I don't know the specific association, and I tried to pick one that wasn't very large because sometimes you have a page of these things on here. So anyway, just wanted to point that out because a lot of people will miss that, and same thing will be up in the accounts receivable. The next report is a fun one.
Thanks, John.
This is a cash disbursements. It literally is what it says it is. So this shows you by account. So 1,000 for us is our operating GL bank account number. So it's on the GL. It doesn't show you the name because it has the association name, but that would show the name of the account. And this is everything that's happened in that account outgoing. And what you can see is there's ACH, there's transfers. Avid is a check being cut. This other Avid, I don't want to go into too much detail, but like when there are active pays, they call them, where the this is the water bill. They came and took the money from the account versus us sending the money to the account, kind of thing. So there's two different ways to do it. Keep going down, just gives them an idea of the different expenses. And this is all recorded in your general ledger, your income statement. Here, this is out of your reserve account. So this is money that for one reason or another, in fact, you can see here, they were opening a new CD. So they transferred out money of $54,000 to basically open a brand new CD. And this is one of the places you would find it. And then here they're transferring money to the operating account for whatever reason, and probably because they just didn't have enough. But all of this kind of gives you as the board a quick look down. I would always look at this report just to see and make sure you don't see something that doesn't make sense. Like if you see an individual's name, you might want to question, hey, wait a second, what is this? And you might know, because it depends on the board. Some boards are very intimately involved in all the expenses. Some allow the managers to do their jobs, which is to take care of this stuff for you and make sure this stuff is happening. But it depends, some are more involved than others, but still it gives you a good picture. You can keep going. There's only a couple more reports. The general ledger. This is the detail behind everything in there. So I'm just going to go over this one page and then we'll slide down the pages. So this first one, again, this is the operating bank account. It shows you the beginning balance for this particular month was 6,000. And this is where it's a little odd, but debits and credits, you just got to get used to it. If you're going to read a general ledger, it's going to cause you a problem. Normally, a debit is an expense or an outflow of cash of some kind, and a credit is an income of cash of some kind. So that's just the normal way these happen. But then you can go down and it shows you how much in total happened for this specific account and what the balance is. That balance would tie, not in this case, but it ties to the balance sheet. And you can just slide down. This is a lot of homeowner detail. That's why it's blocked out. And then you can see some of the payments, they'll tie to the ones above, and so on. If you keep going. And you can just keep going. And then it will go through every general ledger account you have, accounts receivable, all the ones we saw in the balance sheet and the income statement. The normal way a general ledger goes is it starts with the balance sheet accounts and it rolls through and keep sliding down. I'll tell you when to stop because it's probably going to be, this one wasn't really big and I picked it specifically for that. Keep going right after retainer there. So right there at 5,000, that's the first income item, which is the income statement. So in this case, it happens to be the assessments coming in, and these people took in 82, 44, and 84, and that's all the detail behind it. Each one of the ones. So keep going, and we'll just get to the end. The only other important thing. Oh, sorry. Reserve items are also listed in here. As you can see, it said reserve transfer income. It kind of shows different titles. And the nice part about the general ledger, it is very detailed. Most of you don't want to spend much time in here. This would let your accountant do the detail work for you and find questions you might have when you find them on the income statement. Keep sliding down to the end of the report because I just want to show them the one last thing that's important is right there. It should balance to zero. See, if it for any reason ever doesn't, it should never have gotten to you. First of all, the accountant should catch that and say, wait, I got a problem. Let me go find what happened and fix that. The system actually does all this. So we're pretty confident in this, in the way that these come out to zero, but it could happen. There could be a one-sided type entry, which the system doesn't allow, but who knows? Something could happen and something weird could happen. But again, this is real important. It should always end zero for you because the debits and credits should equal. Because again, in accounting, all your debits and credits when tied together equal to zero. Keep going.
Yeah, and I think that just generally speaking, I think the debit and credit like offset is what in my experience, boards tend to have the biggest struggle with. Just understanding like the why of why it has to balance. Sometimes they get tripped up seeing like an offsetting debit and credit, thinking that might mean that they didn't collect income because it's offsetting. So is there like anything else, John, like in terms of just very layman's ways of understanding like the offset of debits and credits so that boards don't feel as like uneasy or uncomfortable looking at a general ledger?
I would truthfully, I would tell boards almost don't go into this detail because this is a very small general ledger. I tried to pick another one that had more units than this, and it was 50 pages. And this one is about 8 pages. It's not a lot because I purposely picked their January one, which didn't have a lot of transactions yet, and so on. It becomes a lot of information. Like when you see your financial package, the 2 biggest things that are going to be in there is your general ledger and all your invoice copies. Okay. And so your package may be 60 pages. 20 of them are going to be your general ledger, and 25 or so or more are going to be your invoice copies, which we do give. I didn't put copies in this presentation because I just figured I'd talk about it. But if the reality is, you guys, if you look at your income statement and your balance sheet, and the reason we start with the balance sheet, it really is where things get messed up. I'm going to just say it that way. So all of you probably remember Enron. Enron got in trouble over their balance sheet. They were hiding things on their balance sheet. Okay. And that is the worst thing that can happen. That's why I'm very much a stickler for what is here. Why is it here on the balance sheet? And when is it going to disappear? You know, not cash, but like the other accounts there, accounts receivable. I don't want to see accounts receivable. I want to see everything collected. Prepaids. I don't want people paying me in advance, even though it's nice. I want it nice and, I'd like to see it clean, but it's still one of the important reports and probably the most important because it tells you how much cash you got. And ultimately that's your main thing. The second thing is how much have I spent, which is your income statement. I'd look and spend most time on that. And then if you see things, and like I said, if you're really involved, you'll kind of know. And when you look at the cash disbursements, you're going to know. And then if you really are into it, you come in here. Again, remember, if you see something on the debit side, that is an expense, okay, on most of the report, meaning you've kind of, you've spent something. A credit is a liability in some cases. And sorry, this is where it gets complicated. And that's why I try not to get into it. But in the bank account, you're getting money in. Okay, that's your credit side of it. So anyway, keep going. We'll go to the next thing. Here it is, the bank reconciliation. Probably, again, one of the most important reports you might look at. This shows you bank balance. So this ties to the bank statement, period. And then it shows you the adjusted balance and the book balance. And again, it should just all be balanced. The real thing you as a board should be looking for is uncleared items. What you're worried about is, see how there's one item here and it's just below the 630. If you start to see things sitting there for more than a month or so, that's a problem. And we as the accountants should be bringing that up to you and saying, hey, this check never got cashed for one reason or another. Or in this case, let me make sure I say this right. This was a deposit coming in. No, this was an outgoing because it's got a check number there. So this was an outgoing. So this check just hasn't cashed. Now it's dated 6/30 and this is a 6/30 report. So I'm comfortable with that. But let's say that said April and it's now June. That's a problem. The guy or business has not gotten their money. And you'll probably be here. The manager, somebody's going to be hearing about it. And so it should be questioned. Somebody should put a call in. Then below that is not as important, but all the reconciled items, all the pluses and minuses of things that came in and out of the bank. So this gives you a little more detail than the actual bank statement, because the bank statement will be like maybe some numbers, and this kind of is numbers too, sorry. But it gives you, you see some titles of things, Travelers Insurance, Denver Water, XL Energy, and so on and so on. And again, one of these for each bank account. Now, I did not add the bank statements here only because, and invoices, because again, they show too much not proprietary, but specific information about an association, and redacting that would take out almost half the report like this. And so it becomes a little like, not probably the right thing to show. But part of your package would be the bank statements right behind that. And then after that is all the invoices that were paid in that period, you get copies of into your package, monthly package that you get. So now let's go back to the presentation, because I think that's what this was. And again, I tried to show you that. Do you want to go through the budgets?
Yeah, I'll just touch on this briefly. Mostly, I think what'll be useful is that I do link to, if any folks on this call were at the budget presentation we did about 2 weeks ago, A, thank you. B, if not, we did link here to the recording from that presentation, and that'll be on our website as well on Thursday. So a nice plug to be able to review our session on budget planning for this year. But just briefly, as you guys saw on like that income statement report that John walked us through, your budget, fairly self-explanatory, but that's what provides you that estimate of your association's revenue and expenses for the coming fiscal year. So all of this financial reporting that we just reviewed, this is what data is going to help inform, current year-to-date spending. It's going to inform your manager putting in those projections for year end. It'll also inform your manager and the board in what projections for next year's budget column you'll be inputting as well. Just as a recap, we use a combination of zero-based and historical budgeting. So obviously, from just a responsibility standpoint, being able to justify the dollars spent is a big part of what we do in terms of budgeting our draft. Now, that said, historical information obviously helps inform a lot of those line items. So as John mentioned previously, ultimately, we're trying to get to a zero kind of break-even number in the way that associations operate as not-for-profit corporations. But from a budget standpoint, we are using those historical numbers on your expenses, revenue, and other financial transactions to help inform what we're putting together for your estimated expenses and estimated revenue. And again, this when we send out a copy of the presentation, this is an active link. This will take you right to our recording on that session along with the notes associated with that. And then obviously budget will help determine how your homeowner assessment should be planned for the upcoming fiscal year. Whether you guys have done really well and you guys are on pace to keep a fairly flat assessment level. Normally, we're going to recommend at least a nominal increase year over year, keeping up with at least CPI and other inflationary factors. But estimating those expenses properly will help inform where you get to in terms of your recommendation for assessments for next year. And then finally, as John had alluded to, reserve studies, they're huge. There's a higher degree of importance put upon them, not only because of upcoming Fannie and Freddie guidelines that are more than ever relying on communities doing reserve studies, but for you and your community, they're also just an extra insurance to help ensure that you're following through with your fiduciary responsibilities. The reserve study helps you get that outlook on your future capital spending. So if you do have one, do use it and actually have it contribute to your budget process. Make sure that your manager is also referencing it. If you have not done one yet or have not done one in a long time, talk with your management team and the rest of the board about it, because it might be time. General best practices, at least, so some states, like John was alluding to, I know in Nevada, Florida, a number of other markets across the US, they're in states where reserve studies are already a requirement. Certain states have been passing legislation the last few years or upcoming for January of 2027 to make them a mandate. In other states, it's just more of a best practice. So every 3 to 5 years, you should be updating your existing reserve study or getting a new one. But the reserve study is becoming more and more of a crucial document to help inform the way that you're budgeting for reserves contributions going forward. So we do have also next week on the 21st, a whole session strictly on reserve studies. So if you need to learn more, if you find that a useful topic, definitely recommend attending that one. Invites have gone out to that for that as well. John, did you want to cover audits, reviews, and compilations just briefly?
Yep. I'll do this one real quick. So when, and I say when because almost every association ends up getting some type of an audit or review at some point. Basically, there are 3 different types of independent reviews that can happen. Okay, an audit, a review, and sorry, that same word, audit, a review, and a compilation. Okay, compilation is useless. It's basically putting your financials together. Well, it's not useless for you guys. It's useless because we're doing that already. So, you don't have to go to an outside independent one, but an audit or a review. An audit is a detailed look at your financial presentation of the statements at a point in time. Again, they look at the whole year. Let's say you say, hey, I need one for 2025. And they go and they do the review of the audit. Sorry, I don't want to mess those terms up. The audit of those financial statements. They'll do some kind of sampling. They'll talk to people. They'll do all these tests so that they can give you an opinion on your financials. The reports can be quite helpful because they do talk about reserve studies and reserve items. A review, as I said, they're much less thorough than an audit and also less costly, but a very significantly lower level of assurance. Basically, in an audit, they're going to say, in our opinion, the financial statements are properly and fairly represented. In a review, they won't say that. Okay, they'll say, we looked at certain things and those looked okay, period. They're not going to say that everything's okay. They're not going to say that things look good. They're going to say exactly kind of what they looked at. And it's just a very different thing. In some states, audits are required based on the size of the association and the size of money that's going in and out. Like Nevada is a perfect example. I've worked a lot with them. And based on the size of the association, they either require nothing if they're tiny, a review or an audit. Once they get over about $50,000 in assessments a year, they require an audit every year. And the good part is, as we say at the end, it's once you get into an annual engagement, it's much easier on everybody, because your auditor already knows the system of internal controls that exists. And that's really the key right there. They're looking at your internal controls or our internal controls and saying, yes, this is fairly represented.
Excellent. Thanks, John. And then just final point on that too, and this comes from personal experience dealing with auditors and CPAs, if you are considering like the audit or review route for your community, annual engagements are generally more valuable and more helpful. Like I think auditors often get contacted by communities where they're like, hey, we do an audit every 3 to 5 years. And realistically, their audit's going to be very expensive and very time consuming if they're having to go in every few years and run through all of that financial data. So if you are a community that finds that you do need one, generally annual basis for those audits is preferred rather than just doing them kind of willy-nilly. Usually you want either that annual cadence or something really driving that need for that audit to take place. And then just final thing that I think is just a culminating kind of slide as to like the importance of reviewing these things and ensuring that you guys have a good sense of those financials and really understand them and know what to do with them is just fiduciary duty. The ultimate things that come with fiduciary duty and the importance of it are threefold: duty of care, duty of loyalty, and duty to act within the scope of authority. So your duty of care, that's going to be that the board members must make informed, thoughtful decisions by reviewing relevant information, attending meetings, and considering how decisions affect the community. This includes seeking advice from qualified professionals, whether that's us as your community manager, attorneys, insurance brokers, accountants, CPAs. Duty of loyalty is going to reference putting your association's interests above the personal financial interests of yourself. So ensuring that you are either disclosing conflicts of interest where they do exist or never using your position for personal gain. So duty of loyalty is a huge one. And having a good sense of your financials and the ins and outs of what your books look like, the inflows and outflows, that helps ensure that that duty of care, duty of loyalty is happening as it needs to happen. And then ultimately that you're acting within the scope of your authority, things that you're actually empowered to do as a board member as defined by your CC&Rs, state law, and any other regulatory kind of bodies or legislation. John, do you mind just taking us through our final kind of conclusion items here?
Yeah, sure. So again, as Eric just went through, board members, a duty of loyalty and ordinary care. I like that because that's really the standard is, making sure that you guys understand what's going on and that you're looking at it as a whole. You want to do the best thing for the association as a whole. Oh, we get a question. Oh, are we taking questions, Eric?
We are.
All right.
Julie, go right ahead.
You're probably on mute.
You're muted if you are talking, Julie.
Okay, I'm so sorry. I actually intended to write a little note, so I didn't mean to interrupt. So first of all, apologies. So my question is, what is the level of reporting that owners, so not board members, have a right to receive on an ongoing basis?
Well, you want me to do that one, Eric?
Eric had to jump off for another meeting, John. So this is Steve, and I will proctor here through these questions. But yeah, if you would take that would be great.
Absolutely. So you saw all of those reports that we went through. Basically, as a board member, you get that full package. The homeowners, the only thing in the states I know of that have laws about it, are required to get the balance sheet and the income statement. That's it. So they don't get any other detail. They don't get accounts receivable, none of that other stuff, just those first two reports.
So they have a right to receive those. Is that right? So
I have
the board.
Hold on.
Okay.
I have to verify that in Colorado. Okay. I don't know what the law is. And if one of you guys, one of the managers know the laws and can tell me, that'd be great. Cause sorry, I wasn't ready for that.
Yeah, John. Yeah, that's what we published to the website for homeowners is a homeowner package that has that information that once the financials have been published, they are also published to the portal for homeowners to see as well.
Perfect. Thanks, Steve. Yeah, I didn't know what was legally required. So
yeah, that quote unquote legal. I that might be a sticking point, Julie, but I know that that's what we share, and that's what homeowners have access to. You know, it's just anything that doesn't include personal information, like what homeowners owe money, outstanding balances, etc. So the general information is shared with everyone, so we're all on the same page.
All right, perfect. Thank you.
Sure. Does anyone else have a question for John or your Colorado team? Well, excellent. John, thank you so much for taking this time to speak with us and speak with Colorado and help us increase our financial literacy. Everyone who joined, appreciate your time. We'll let you get back to a hopefully lovely summer evening. Take care, everyone, and be on the lookout for those things Eric was sharing, the recording of this, notes, etc., so you can share it with your fellow board members. So with that, we'll say good night and wish you all the best.